So you want to be a profitable trader and you can't calculate your risks per trade. No trader should enter any trade without knowing how much it's going to cost him if he loses that trade, okay? In this video, guys, if you watch to the end, you will forever know how to calculate risks on every single trade you take. Hello guys, welcome back to Right Way Traders. This is where we talk about Forex reality, the real truth in trading that nobody talks about out there. This is where you get it. So today we are talking about risk management, very important aspect in trading. If you are a trader and you don't know how to calculate risks in your trade, you are not a trader yet. You are just a Forex gambler. So this is one of the skills you need as a trader to know this before you go into any other aspect of trading. Learn how to calculate your risks because you are always limited in your capital. The Forex market is so large, $1 billion, more than $1 trillion market, and you are just coming in with just your $1,000 in there. You are very, very limited. So it is important to learn how to calculate your risks for every single trade you want to take so that you protect your capital, you protect your account, because risk management is the backbone of long-term profitability. Yet, it is the most ignored skill in trading. Whenever we are talking about risk management, we are talking about how to manage your risks. So what is risk? Risk is that amount you are willing to lose in a given analysis that is wrong. You are entering a trade and you are wrong and the trade hits your stop loss and you're out of the market. Your risk is that amount you lost in that market. So in this video, we're going to be talking about how to calculate these risks before you enter the trade so that no matter what happens, you already know how much you're going to lose if the trade goes against you. Number one thing, why is risk management important? Why does it matter? Even the best strategy will always fail if you don't have risk control. It's not about avoiding losses, but it's about making sure that not a single trade can wipe your account. You understand? Or a losing streak will not be able to wipe your account. Following a risk management rule to protect your capital. This is why it is important. So talking about risks in percentage, how much are you supposed to risk in a given trade? My advice goes to especially beginner traders. Whatever account you're trading, so long as it's a demo account as a beginner trader, you're not supposed to go into a live account yet until you've had at least a 6 months trading report and show that your 6 months trading report is positive before you can go into a live account with the same techniques that you use in your previous demo account trading. So for beginners, don't risk more than 2% of your demo account. We are going to get there on how to calculate this, okay? But I'm just giving this so that you know what to do after now. So for the advanced trader, that's people that are already profitable from their demo account for 6 months minimum. Then you want to dive into it with your live account. And because you want to be making money with this, our advice, you increase your risk, because risking 2% and trading the daily time frame chart that we trade, which is very slow, will give you a little profit on the long run. But as an advanced trader, risks between 5 to 15% depending on the account you are trading. Okay, I'll break this down a little bit. So let's say you are having a $5,000 account. To me, if you are trading a large account like $5,000 or more, risks not more than 5% on that trading account. Okay, then if you are trading anything less than that $5,000 but is above $1,000, that's like a mid-range account, I would advise you risk 10% of your trading account. You understand? People will say that this risk is too high. It is not too high in our pattern of trading. We trade the daily time frame. In a whole month, we'll take average of 5 to 3 trades. We don't trade too much. And if we are gaining, we are gaining a lot. If you are losing, we are losing not more than 10%. If you are trading on a mid account between $10,000 to $5,000. Okay. Now, if you are trading on any small account less than $1,000, because you want to make the money, you have to increase your risks to 15% per trade. Remember, we are trading on the daily time frame, lower trades but higher profits. Risk 15% of your account if you are trading little account. This should be done only when you have passed your 6 months demo account trading and you want to repeat the same step. The only difference now is to increase your risk because you need a return. If you are trading a low account such as, like, let's say $500, $200, which you are not supposed to be trading because it's too small, and you want to be risking 1%, 2%, on the long run, you find out that you are not making something tangible. You are just joking. So, which is why we advise increase your risk percentage to 15%. if you are trading smaller account. This will affect your drawdown, of course. Your drawdown will be massive, but on the long run, you are making more money. It's something tangible out of the market, okay? Or else, better still, you acquire a Profem account. That being said, let's go into how to calculate your risks, which is the most important thing down here. So you already note how much to risk in your trading account, which is relative. Then how do you calculate your risks? Let's go down into this. Four major things to note in calculating your risks before you enter a given trade, okay? Being that we are trading the higher time frame, which is the daily chart, our trading is very gradual. So if you follow these steps, you're not going to make mistakes. People that make mistakes are those people that trade lower time frames, because the chart is faster on the lower time frame. They have no time to calculate their risk, so they just enter randomly, which is why the higher time frame is very important. There will be a video I'll be talking about the time frame to use and how to trade the forex market using the higher time frame, okay? Not on this video. If you are watching this video and maybe I've already made that video, you should search on our YouTube channel for trading the best time frame to be trading on, okay? So these four things to note before calculating your risks is the pair you have analyzed, which is the market you want to trade at that moment, okay? The next thing is to identify your capital or your trading balance, which is your equity, how much is left there. The next thing is to note the percentage you're supposed to risk, which I spoke about recently. So I'm going to give an example concerning all of this. Then the next is to define your stop loss and distance in pips, okay? If you check down, we've spoken about stop loss in pips when we talk about trade management. So if you've not watched that video, go ahead and watch that video, trade management, how to note where to place your stop loss and how many pips you're supposed to give to your stop loss, okay? Now, these are the values you need to get before calculating your risks. After getting these values, you have to use the calculator in calculating your risks, because if you want to do this mathematically, it's a very long process, but there are calculators that will help you do this very fast. I will show you that calculator in a split seconds, but let me give you the example that I'm bringing up on this. Okay, let's say that you have $5,000 capital. From the instruction I gave, 5,000 above is a big account, so you have to risk not less than 5%, okay? And we are risking 5% of this account. So 5% of $5,000 is $250. In order to calculate this, in order to calculate your percentage of your risk, what you have to do is that percentage, since we are risking 5%, so 5 divided by 100 multiplied by your trading account, which is $5,000, it gave us $250. So we are risking $250 in this trade. And let's say the ATR gave us 50 pips. So our stop loss is going to be 50 pips stop loss. Okay. So we've gotten how many values here now? We've gotten 3 important parameters here. Now the fourth parameter, which pair are we analyzing? Which market are we trading? So let's say we got our analysis on the Euro USD. Okay, so the Euro USD is a forex pair, and that is where we got our analysis to buy this pair. Okay, now what we want to calculate is the risks to use, and risk calculation is all about lot size. So the lot size is your position size, which is your risk size. Okay, so we have $5,000 capital, $250 risk on the Euro USD and 50 pips. Now let's calculate the lot size to use on this trade. Let's go down to the calculator. So guys, this is the calculator you have to use in calculating your forex trading account. It's called the forex calculator. You can download it from Play Store or iPhone Store, whichever platform you are using. There are several other calculators. They are basically the same thing, but I'm going to use this one as an example. So using this as an example, once you launch the app, you are going to see where it's written position size calculator. Now that's where I'm going to click, which is this down here, position size. Okay, I'm going to click that to open the position size. Now this is this is where we have to input our parameters, those parameters that we have. So we are trading the Euro USD. I'll select the Euro USD here, Euro USD. How much are we risking? We are risking $250. Okay, how much is the stop loss? We inputting 50 pips stop loss. Okay, now this is it. We'll click on the calculate button. This is the result of what we got. Standard lot size. Okay, the standard lot size to use for this trade is 0.5. 0.5 lot size is what we are going to use in this trade. That's what the calculator told us. So that's how to calculate your position sizing. So if you are going to enter this trade, we'll now use 0.5 lot size in buying this trade, inserting our stop loss and our take profit point, and then we are done with that. So that is how to calculate your risks in forex trading. Very simple. It may look challenging at the very beginning, but if you are doing it multiple of times, you see that it's actually easy to understand and carry on. Now, next, let's talk about over risking in correlation and exposure. Very, very important. In fact, I've not seen people talking about this. I see them doing it in their account. They are overexposing their trading account and at the same time trading on a correlated pairs. So what are correlated pairs? Correlated pairs are pairs that basically behave the same way. Okay, if you are trading the forex market, you notice that there are pairs that behave the same way and have almost the same history and chart pattern. Okay, so it is your duty now to note those pairs that are correlated so that you don't over risk. Let's say you are trading on a pair that is correlated to another pair and you are trading both of them at the same time and it happens to be a loss. It is 90% certain that those two trades are going to be on a loss, which is why you need to note the one that is correlated to avoid this. I'm going to give you a hint shortly. For example, buying the Euro USD and buying the GBP USD at the same time is doubling exposure on the USD currency. You see, because the USD is the common thing there, and because you are selling the USD on these two pairs, you are selling the USD twice. So if in any situation you see these two kind of trades, it means you are exposing a money on the USD. So either you pick one of these trades or you split your risks on both of these trades. Okay. So this usually happens when your analysis gives you more than one pair to trade. Okay. If your analysis gives you more than one pair to trade, you note which of the pair is correlated, which currency is common there. Like the example I gave, the USD is common there because you are selling the USD. If you are buying Euro USD, you are selling USD. If you are buying GBP USD, you are selling USD. So if you are selling the USD twice, you are exposed twice. So risking 5% on each of those trades means you are risking 10% on a single trade. That is what it means. And you are not supposed to risk more than 5% of your trading account, which is why you are being exposed here. To go deeper into correlation and exposure, make sure you get the indicator algorithm trading course. Everything is being explained here on how to use risk management, how to manage your trade, how to analyze and trade the chart, okay, to understand better in the forex market. Go and get this course to understand everything we are saying. So, talking about this exposure and management, try and avoid taking trades that add up to like more than your risks. Okay, like what I just said, don't over risk more than what you're supposed to risk, and you should note this because this is business. If you make any slight mistakes, it's affecting your trading capital, which is your money. Okay, always check what is my total open risks across all positions. So if your positions are open, how much are you risking in all those positions? How much are you giving at stake? This comes in when this is where correlation and exposure comes in. It's a very technical thing in forex trading, which is why I advise you join us on Telegram, follow us, and get this indicator algorithm course. Everything was explained down there on how to use the correlation and exposure. I'm going to give you a very small little hint that will help you in risk exposure in trading the forex market. Remember, I always say this: forex market is different from gold market, is different from Bitcoin market, is different from oil market. Okay, forex market is just for mainly the currency pairs. Okay, so this hint I'm going to give you is trading the currency pairs, which is forex market specifically. If you want to be avoiding all these exposures and correlated pairs and over risking, what you have to do is to pick only one pair at a time. No matter how many signal your analysis is giving you, pick just one and trade that one. That's the hint to avoid all of this if you don't really understand correlation and exposure. So remember, risk management is not about being conservative. It is about staying in the game long enough so that your strategy will work. So if you protect your capital, the profit will take care of itself. That will be that for now. Subscribe to this channel, like it, share it to your friends that will find this usable, okay? And wait for the next video coming up shortly. See you guys.